Hello, my name is Justin Lake from Think Numbers, and today I'm going to go over a question which we're actually going to be looking at how to calculate some cash flows that are paid to suppliers, and we're going to be doing this using the direct method of cash flows. So first let's look at this question. So we've got some information that is off a balance sheet and income statement for this particular company. So a balance sheet and income statement of Koala & Co. Limited show the following for the year ended 31st of December 2016. The starting inventory of the 1st of January of 250,000, inventory at the end of December of 310, accounts receivable on the 1st of January of 450,000, accounts receivable at the end of December of 480,000, accounts payable on the 1st of January of 120,000, accounts payable at the end of December of 210,000, sales of $990,000, and cost of goods sold of $500,000. And so the question here is, what was the cash paid to suppliers during 2016? So how would you actually approach this sort of question? And this is the way I would actually approach this. So the first thing to consider is some of the keywords around here, which is actually the cash paid to suppliers. So firstly, this is indicating that this is actually a direct cash flow method that we could actually work out. There are potentially you could use the indirect method, but I'm going to show you this using the direct method. And so what are the actual accounts where cash actually goes through that you would actually be able to extract this out of? So now, do they go through the inventory account? Well, there's no actual cash flows that go through the inventory account. There's only the asset purchases of inventory, and also when you sell the inventory to transfer it to cost of goods sold. Accounts receivable is all about the cash you collect from your customers. So that's where your sales invoices go into, and that's also where you collect money. So the question here is about cash payments, not cash collections. Then you have accounts payable, which is actually your supplier accounts. And this is where you have an opening balance. If you make any purchases or you have invoices during the year, this increases, and then it decreases when you pay the cash out to the suppliers. So that to me looks like the right kind of account we should be looking at to determine what is our cash paid to suppliers. But how would you actually then determine this using the direct method? Well, I'll actually show you this using the T account method of actually reconstructing the accounts. So let's do a T account. We're going to do two T accounts. We're going to do first of all, we're going to do the accounts payable. We'll call it AP. Remember, this is the liability account. And so we have an opening balance of 120. So it goes on the right side because it's a liability. It has a closing balance of $210,000. What actually makes accounts payable increase, now the increases for liabilities go on the right hand side, is purchases. Now purchases come from inventory accounts. So when you make purchases, this is where the account that we're actually going to need to determine purchases. So we'll put here purchases. And what actually decreases accounts payable is cash, when you make cash payments. So we don't actually know what that is yet. So if you think of this almost like a sort of a puzzle, we need to work out that component in order to work out that component. However, in order to work out the purchases, the other side of purchases will be inventory. So we're actually going to reconstruct inventory account as well, which is actually your inventory of stock accounts. And in this case it's an asset account. We have an opening balance of $250,000. We have a closing balance of 31st of December of $310,000. What actually makes inventory go up are purchases, we'll call it P. And what actually makes inventory go down is when you sell the inventory, it actually transfers to cost of goods sold. So that's actually going to be your COGS. Now we actually do know that amount in this information, which is $500,000. You can see that it's on your income statement. So to work this out, this is the component we actually need to work out. So what we're actually going to do is we're actually going to take our opening balance, which is $250,000. We're going to deduct our cost of goods sold, So 250 minus 500 is negative 250. And then it has to go from a negative position of 250, because that's positive, negative. So we have to go from negative 250 up to 310. So then if we add 250 and 310, we've got 560K of purchases. And the other side of this journal entry is the debit side goes to inventory and the credit side actually goes to accounts payable. And so that is the actual purchase amount of $560,000. And then really the final step to this is then to work out this cash component, which is what the question is asking. So if we start off our opening balance of $120,000, we're going to add our purchases of $560,000, and it ends up going down to a closing balance of $210,000. So if we add those two together, we get $680,000. And if we take off the closing balance of $210,000, the only difference is the cash component of $470,000. And that is how you can work out your cash component of cash paid to suppliers during this financial year. I hope you've enjoyed this lecture, and please like this video and feel free to subscribe to my channel to see more videos on different accounting solutions.